Here's a number that should bother you. The average American investor has underperformed the S&P 500 by nearly 4% every single year for the last 3 decades. Not because the market was rigged against them, not because they picked bad stocks, not because of some hidden fee buried in fine print. They did it to themselves. And the wild part? Most of them are still doing it right now, today, without knowing it. This isn't a story about greed. It's not about Wall Street villains or shady brokers. It's a story about what happens when a smart, rational human being is handed a system that quietly punishes patience and rewards panic. By the end of this video, you'll understand the one mechanism that has cost everyday investors more money than every bad stock pick, every bear market, and every recession combined. Why this matters now. Right now, more Americans own stocks than at almost any point in history. Nearly 60% of households have money in the market, mostly through 401ks and index funds. Robinhood, fractional shares, zero commissions. Investing has never been easier to access. You'd think that would make people better investors. It hasn't. Because access was never the problem. Behavior is the problem. And the modern investing app, ironically, has made that behavior worse, not better. You now get a push notification every time the market moves. You get a real-time chart of your net worth, updating every few seconds like a heart monitor. That's not a feature, that's a trigger. How the mistake actually works. Here's the mechanism step by step. Step 1. The market drops. Doesn't matter why. Inflation data, a Fed meeting, a headline about a bank somewhere. Markets do this constantly. Historically, a 10% drop happens on average about once a year. Step 2. The investor sees the drop. Not next week, not next month. Right now, on a screen in their pocket. Step 3. Fear kicks in. And this isn't a character flaw, it's neurology. Losing money activates the same part of your brain as physical pain. Studies in behavioral economics have shown that the pain of losing money is felt roughly twice as intensely as the pleasure of gaining the same amount. This is called loss aversion. It's not a bug in human psychology. It's the default setting. Step 4. The investor sells. Not because the fundamentals changed, not because the company is worse than it was yesterday, but because the discomfort became unbearable. Step 5. And this is the part that actually destroys wealth. They wait for things to calm down before buying back in. But markets don't ring a bell when the recovery starts. By the time it feels safe again, the rebound has usually already happened. This isn't a one-time event. It's a pattern. It repeats every single time there's volatility, and volatility by definition happens constantly. The uncomfortable math. Now here's where it gets genuinely brutal. Research from Dalbar, a firm that has tracked investor behavior for over 30 years, found something remarkable. If you'd simply put money into the S&P 500 and never touched it, you would have earned close to 10% annually over the long run. The average investor? Around 6%. That gap sounds small. It is not small. Compounded over 30 years, a 4% annual gap doesn't just shrink your returns, it can cut your final portfolio in half. Half. Not because of a crash, not because of fees, because of timing, because of fear, because of selling low and buying back high over and over, believing each time that this time they were being smart. And here's the twist that makes this so hard to fix. Missing just the 10 best days in the market over a 20-year period can cut your total returns by more than half. And those best days almost always come right after the worst days, when everyone is too scared to buy. The people who did the worst weren't unlucky, they were reacting like humans. That's the whole problem. Hype versus reality. The hype says, buy low, sell high. The reality is that no one rings a bell at the low. The bottom of a crash and the peak of a recovery both look identical to the investor living through them. Terrifying and uncertain. The hype says, just do your research and pick winners. The reality, according to decades of data from S&P's own Spiva report, is that over 85% of actively managed funds, run by full-time professionals with research teams, fail to beat a simple, boring index fund over a 15-year period. Let that sink in. Professionals whose entire job is timing and picking mostly lose to doing nothing. So, if trained professionals can't consistently beat panic-proof investing, what chance does someone checking their portfolio on their lunch break actually have? Zooming out. The bigger implications. This isn't just a personal finance problem, it's a structural one. The entire financial media ecosystem, cable news, finance apps, social media, makes money from your attention, not your returns. A calm market doesn't generate clicks. A market in freefall headline does. So, the system that surrounds your money is built, whether intentionally or not, to keep you anxious. And anxious investors trade. Anxious investors check their accounts 15 times a day. Anxious investors make exactly the decisions that Dalbar's data says cost people half their wealth over time. Zoom out further, and this becomes a generational issue. Retirement in America increasingly depends on individuals managing their own 401s, with no pension safety net behind them, which means this one behavioral mistake, panic selling during volatility, isn't just shaving off some upside. For millions of people, it's the difference between retiring comfortably and running out of money in their 70s. The mistake isn't a lack of financial knowledge. Most people know intellectually that they're supposed to stay the course. They know the phrase, they've heard it 100 times. Knowing it and living it, when your portfolio is down 20% and every app on your phone is flashing red, are two completely different things. Closing, the lingering question. So here's the uncomfortable question this leaves you with. If the single biggest driver of investment failure isn't ignorance, isn't bad luck, and isn't even bad advice, if it's simply what happens when a scared human being is given a real-time window into their own net worth, then is the modern investing app, with its instant notifications and live tickers, actually helping you build wealth? Or is it just giving you a front row seat to your own worst instincts, dressed up as financial empowerment? Maybe the real edge in investing was never about finding the right stock. Maybe it was always about being the kind of person who could stop looking. Disclaimer: this video is for educational and informational purposes only and should not be considered financial or investment advice. Always do your own research before making any investment decisions.